Financial Modeling, Topic 15, Building Stochastic, Free Cash Flow, and DCF Models Using Excel and Risk. Copyright Lugatas. In this topic, we're going to forecast and simulate free cash flows, value common stock using a DCF model, and then use at-risk to do simulations of those models. So the basic steps to doing a simulation is you first create a financial model. And for example, we're going to do models that estimate free cash flows. Now, for it to be a simulation, you have to choose at least one of the parameters of the model or its variables to be stochastic. Stochastic meaning that the variable can have more than one value, and you can describe the distribution of that variable. For example, you may have asset prices as a variable in your model, and those asset prices you may assume are, say, normally distributed. In the model, you also have to specify the correlations among stochastic variables. So now you have a model to estimate some outcome, say free cash flows, and has multiple stochastic variables where the distributions are defined and the correlations established. You would then run your simulation, sampling or creating random numbers or values for those variables, and then you would look for, say, the mean or percentiles of the distributions. So, for example, let's do a simulation of the Hoffman Gold Mine. Now, the Hoffman Gold Mine operates in the Klondike region in Canada. Their sole revenue is gold they dig up that they sell at market prices at the end of the season. And their primary expense is diesel fuel for operating their expenses, which are a bulldozer, excavator, loader. And the basic mining process is that the equipment, say bulldozers, are used to move away the topsoil. Once you get away from the topsoil or get the topsoil removed, you then get the dirt that's sitting on top of the bedrock, and that's where the gold sits. We call that the pay dirt. They then transport the pay dirt over to a wash plant, and that wash plant will shake and have water flow through the dirt, and the gold falls through the and captured in filters. So that's the basic gold mining process for the Yukon. Now, if you're interested, you can take this link and look at the actual Hoffman Gold Mine. All right, and this example I'm going to show you is taken from Discovery's show, The Gold Rush. And in Gold Rush, Season 1, I've established this model to help me understand how their profits or cash flows in year 1. So we'll pull our model up. So in the fiscal year of 2011, which was Season 1 of Gold Mine or Gold Rush, the Hoffman Mine operated 84 days. Now, the total season they could have operated is 150 days, which is about the time of or the number of days where it's warm enough to actually get down to the bedrock. So they only mined 56% of the possible days. And the reason why they didn't do more is they had to establish the location, they had to hire equipment, they had to hire men, and so on. So they only wound up mining for 84 days. Each day they averaged about 5 tons of pay dirt that was dug. So 5 tons of pay dirt times 84 days, they got about 465 tons of pay dirt to their wash plant. On average, they recovered about 0.2 ounces of gold per ton of pay dirt. So 0.2 ounces times 465 tons gave them 93 ounces of gold they mined in their first season. Gold was selling for about $1,600 per ounce, which means they made about $148,000 in Season 1. Now, estimating their costs, they used about 200 gallons of diesel fuel per day. Diesel fuel was running about $4.05 per gallon that season. So that will give them a total expense of $810 per day in diesel fuel, times their 84 days they're actually mining. So there's $68,000 in expenses, which gave them earnings before tax of $80,000. If I use a marginal tax rate of 35%, they cleared operating profits or profits after tax of $52,000. I then estimated that a used bulldozer, wash plant, excavator, and loader cost about $142,000. I'll assume they sold that equipment back at the end of the year and it was worth 30% less, so they got $99,000 back. So their net capital expenditures were $42,000 for the use of the equipment for the season. If I then take my earnings of $52,000, subtract out my capex of $42,000, they made about $9,969 is my estimate in season 1. Now to think about how to use financial models, I'm going to then forecast season 2 based on some promotional information I've seen about season 2 and some guesses I'm going to make. So I'm going to first do a static model. In other words, a model in which I have just one value. So I'm going to assume there's still 150 total days, but I'm going to assume that they are going to mine 70% of the time. You know, the promos showed them getting an early start and having equipment ready and land all set, so they're going to mine 105 days instead of 84. I'm assuming they can still get the same amount of pay dirt per day. That will get them about 580 tons of pay dirt to the wash plant. It looks like they may have a better piece of land next year, so I'm assuming they're going to get a little bit more gold per ton, which will give them 174 ounces of gold. I'll assume that gold prices increase with inflation. So gold prices go from $1,600 to $1,632, which means I'd estimate revenues of $284. I'll assume they use the same amount of fuel per day, and fuel and prices increase by 2%. So they'll spend $86,000 in fuel expenses. I'll further assume the same tax rate, and I'll assume that the equipment prices are going up by inflation rate of 2%. So their equipment cost for next year, after selling it back, would be a net capex of $43,000, again 2% higher than last year, which would give them a free cash flow of $85,000. So this $85,000, we'll call that either a deterministic value or a point estimate or a static estimate. All right, this is my best guess for next year. Now, to turn this into a simulation, I need to take a number of variables from the model and make them stochastic. In other words, specify a distribution for each, and then I'll simulate those values, and I'm going to do the ones that are highlighted here. And then I'm going to simulate different 10,000 possible values for those parameters, and then I'll evaluate the results. So for example, let's assume that mining days, even though I expect a little more next year, I think it could be between 55 and 85% of the time. And I'm not sure there's a peak or there's any likely value in between those. I think it's anywhere between 55 and 85, and they're just as likely. So I'm going to use a uniform distribution for that variable. So I click on that cell, and I'm going to select a uniform distribution. Now for the uniform distribution, I just need to specify a min and a max. The static value is what's sitting in the cell. So I'll put in a min, and I'll assign the max from Excel. And there's my distribution. So when I run this simulation, it's going to sample 10,000 possible % mining days between 55 and 85%. And if I graph those 10,000 random percentages, the distribution would look like this. So this is a uniform distribution, so you have no single peak. Like say a normal distribution would have a peak, or a triangular would have a peak. So I'll hit OK. That's my first distribution. The second variable I'm going to look at is ounces of gold per ton of pay dirt. So I'm going to assume they do a little bit better next year using 0.3. But let me assume that's going to be between 0.1 and 0.4. So I'm going to click on there, click Define Distribution. And I'm going to use a triangular distribution. So I'm a little more confident that the number is going to be 0.3. So that's going to be my most likely value. That's going to be the peak up here. So let me copy some values from Excel. So I'm going to say the least amount of gold is 0.1 ounce, and the most likely is 0.3, and the max is 0.4. So my distributional assumption looks like this. I believe 0.3 is the most likely. It could be a little bit better, and it could be a lot worse. And this is based on my understanding of how gold is distributed in the Yukon. All right, you never find that much gold in the Yukon. All right, gold arrived at the Earth from an exploding star, and you think of it that way. So gold is distributed pretty randomly across the Earth, and you never see it too heavily in one particular area. So you're not going to have too much gold. On the other hand, there's a little bit of gold on pay dirt everywhere across the globe. So I'm going to use this distribution. Next, I'm going to do a distributional assumption on the appreciation of gold and the appreciation of fuel prices. For gold, usually when I talk about the appreciation or returns of asset prices, I generally might rely on a normal distribution. So for the 2% appreciation of gold, I'm going to assume that's normally distributed. And I'll put in my mean and my standard deviation. That's all I need to fully describe a normal distribution. And I'll do the same for fuel. Again, I'm just going to assume that fuel and gold appreciate to maybe my estimate of inflation, and I can use some historical estimates of standard deviation. So for fuel, I'm going to define a distribution. Normal. And put in a mean and standard deviation. So now I have 4 stochastic variables. My output that I want to keep track of is the free cash flow. I'm going to add an output. Now if I were to run this model, what would happen is it would generate a random number for mining days, a random number for gold ounces per ton, a random number for the appreciation of gold, and a random number for the appreciation of fuel. And it would assume that those variables are all independent. In other words, these 4 random numbers are independent. But I'm going to further assume that fuel prices and gold prices are correlated. I'll assume that the other variables are uncorrelated. In other words, the percent mining days has nothing to do with the price of fuel. But I'm going to assume that the only correlations, or the only correlated variables, are fuel and gold. Assuming that, say, if we enter a period of higher inflation, both gold and fuel prices are go up, or if the world economy starts improving, both gold and fuel prices could go up. So I'm just going to make that assumption for now. So how I do that is I go into my at-risk model window. I'm going to select my 4 variables, my 4 inputs. I'm going to click right-click, correlate, create new matrix. I need to make sure it's in the same order as my correlation matrix down here. So it looks like I need percent mining. I'll slide gold over here. And then looks like gold appreciation. Well, now it's gold ounces is second. Then gold appreciation, then fuel. So that hopefully looks the same as this one. Percent mining, gold ounces, gold appreciation. And then I'll do another right click. Copy coefficients from Excel. I'll copy the values here, just the values, not the labels. So now looks like my correlation matrix is in at risk and looks the same as this one over here. And then I need to assign this a location in Excel. I'll just put it down here. And hit OK. OK. So here's the correlation matrix that at-risk is going to use. Now I'm ready to run a simulation on my free cash flows for next year. Remember, the static estimate is $85,000. So I'm going to do 10,000 iterations, and I'll hit start. So looking at the output, you can see the mean was about 65,000. Well, it's not finished yet. Let's wait a second. So my mean is about 65,000. And you see the 5% worst case is losing 18,000. 5% best case is making 163,000. And you can see, say, the probability of breaking even. This was about 12% chance we break even, 88% chance we actually have positive free cash flows. Now I could get at risk to put these values into Excel by using Excel's or at-risk risk functions. So I can say equals risk mean. Click on the output, and that'll give me the mean of that 65,000. I can say risk percentile. Click on the output, comma 0.05. That'll give me the 5% lowest. Risk percentile. Output, comma 0.95 will give me the 5% highest. And risk target. Output, comma 0 will give me the probability that the cash flow is below 0. That's my 12%. So this now describes not just the point estimate, in other words, my best estimate for cash flows, but it's given me the mean of the distribution, some measures of best case and worst case, and some probabilities of particular values. So this may allow me to make better decisions. So this is the basic process for doing a Monte Carlo estimation. We built a model that calculated free cash flows. We specified 4 stochastic variables, their distributions, and their correlations. And then we ran 10,000 sets of random correlated variables, and then we evaluated the output to help us make decisions. Now the next cash flow model we're going to look at is for valuing stocks. So when you talk about valuing equity and DCF models, there's generally 3 different models people talk about. A dividend discount model, DDM, a free cash flow to equity model, FCFE, and a free cash flow to the firm model, FCFF. Now a dividend discount model, it's kind of attractive in that the only cash flow that's paid directly from a firm to a shareholder is its dividend. So I could just estimate, say, the dividend next year of a particular firm, assume some constant growth rate of that dividend, G, and then get a discount rate, cost of equity, using, say, CAPM, risk-free rate plus beta times market risk premium, and I can get, say, a constant growth perpetuity value for equity, which is the present value of a dividend that starts at D, this dividend here, grows at some constant rate G, and it's discounted at some rate KE. Now the problem with this model is a lot of firms don't pay dividends. So another model that might work out is a free cash flow to equity. Now free cash flow to equity are cash flows that the firm generates, say revenue minus expenses, minus any, say, capital expenditures, minus any interest payments, minus any taxes. So it's going to subtract all your expenses in the firm and including capex, and what's going to be left over is any cash that could be used to, say, pay a dividend, could be used to pay the share equity holders. So we call those free cash flows to equity. It's all the revenues minus expenses and then what left over are the cash flows available to pay equity holders. So the benefit of this, it works for non-dividend payers, and theoretically, what you can think about this model is if a firm was not paying a dividend, some, say, private equity firm could buy the firm, and then those free cash flows to equities could just go directly to the private equity firm. So the private equity firm might value it at FCFE, in theory, paying itself all of free cash flows to equity as a dividend. So again, we can discount that at a CAPM rate and assume those free cash flows grow at some constant rate at G forever. However, the most common way to value equity seems like an indirect way. We're going to value free cash flows to the firm. Now, free cash flows to the firm are revenue minus expenses, minus taxes, minus capex, and so on. However, you don't subtract off interest. That's the difference between FCFE and FCFF. So you do not subtract interest. So free cash flows of the firm are cash flows available to pay both the bond or debt holders and the equity holders. Since the cash flows are available to both, we want to make sure the discount rate that you're going to discount the cash flows at accounts for the risk of the debt and the equity, and that's going to be my weighted average cost of capital, which is a weighting of a cost of equity and the after-tax cost of debt. However, if we take the present value of free cash flows of the firm, that's going to be the value of the total firm, the value of debt and equity, or total assets. If we want the value of equity, we then have to subtract off debt and say add the cash of it on the balance sheet to get at the equity value. So this would be the total value of the firm. If I then subtract off debt, add cash, that becomes my value of equity. So a little bit more about free cash flows. Free cash flows of the firm are cash flows available to both debt and equity holders. It is before interest and dividend payments, but after taxes. Any non-cash accounting costs, such as depreciation and amortization, are added back since they're not a real cash expense. However, the real cash expenditures for CapEx are subtracted, as well as any working capital, changes in working capital. However, to get to the value of equity, we're going to have to subtract the value of debt to get to just the value of equity. Now, a couple ways of writing free cash flows to the firm. You can say it's NOPAT, net operating profit after tax. Add depreciation, subtract CapEx, and subtract changes in net working capital. However, I'm going to write it this way, and this is a shortcut or a way of doing it that DeModern recommends, the NYU professor that has a book on valuation. So if I'm going to forecast free cash flows next year, FCFF1, one way I could do it is take this year's sales and forecast the growth of sales, maybe based on my estimate of the economy and market share. I'll then forecast the EBIT margin, earnings before interest and tax, so maybe the firm has a 5-10% on average operating profit from sales. I'll then subtract taxes, take 1 minus tax rate, that'll reduce it by taxes. Now to account for, so this part here, sales times 1 plus growth times the EBIT profit margin times 1 minus tax, that'll give me NOPAT. So what's left over is depreciation, CapEx, and net working capital. I'm going to add those three numbers together and call that net reinvestment. So if I take CapEx, subtract off depreciation and amortization, and add changes in working capital, I'll call that my net reinvestment. And if I divide that by NOPAT, I'll call that my net reinvestment rate. So by making this all one, or combining these, I can call that my total net reinvestment in the firm. So say the firm on average invests 20% of its NOPAT profits back into the firm. Well, I would just take 1 minus 0.2 and then I'd reduce that value by 20%. So my basic DCF models, I'm going to take the present value of free cash flows, discounted at WACC. When I get to the point where I believe that those free cash flows are going to grow at some infinite rate G forever, I can then finish off the valuation using a growth perpetuity. And then if I subtract out debt and add cash, that gives me the value of equity. Now I could have done this one other way. I could have taken the present value of cash flows and at some point I can say, well, at some point, I'm just going to use a price multiple. I'm going to use a free cash flow multiple. So I can say that I'll estimate free cash flow for several years. Then in year 5, I'll assume that the total value of the firm is worth, say, 5 or 10 times free cash flows. So we're going to use this model here, but this is a very common model, is to not use a growth perpetuity formula to finish, but to use a free cash flow multiple. Here's our WACC formula. In our WACC formula, we take our CAPM, cost of equity, times the percentage of equity, after-tax cost of debt times the percentage of debt. Now, to get CAPM cost of equity, I'm going to need a risk-free rate plus beta times market risk premium. The method I'm going to use is I'm going to find an unlevered beta for the industry, lever it up by the after-tax debt to equity of the firm, and then use that in my CAPM formula. So these are all the formulas I'm going to use in my spreadsheet. I'm going to say that the value of equity is the value of debt plus equity minus debt plus cash. And if I'm using a one-period constant growth or one-stage constant growth model, I'll take my free cash flow estimate for next year, assumes that grows at some constant rate, G infinite, and discount it at the WACC and subtract off the net debt, which is debt and cash. I'm going to use my formula that the free cash flow is going to be equal to my net PAT, or my no PAT, plus depreciation minus CapEx minus non-cash working capital, which I can then write a little bit more succinctly as my revenue times 1 plus the growth rate times my profit margin after tax multiplied times 1 minus the net reinvestment rate. So the model I'm going to show you actually uses this model, and this is where all the sources are. I'm going to get revenue from the income statement. I'm going to forecast my growth rate of revenue next year by thinking about the economy and industry and company. I'm going to use an historic operating profit margin. I'm going to use a historic tax rate. I'm going to use a historic net reinvestment rate that I'm going to get from the balance sheet. For the weighted average cost of capital, that's down here. I'm going to use, for CAPM, risk-free rate. For beta, I'm going to use the unlevered industry beta times the 1 plus the after-tax debt-to-equity ratio for the firm. That'll give me a levered beta, or equity beta. I'll then multiply times the market risk premium, and I'm going to use De Modern's implied equity premium times the percentage of equity. For cost of debt, I'm going to look in Morningstar and look at, say, yields on their long-term non-callable bonds. I'm going to use the historical tax rates and the current values of debt and equity. For infinite growth rate, I'll assume the company grows at something less than the growth of the nominal growth of the economy. So let's grab the model. So here's my DCF model. And what I did is I valued Walmart. So for the symbol WMT, Walmart, I estimated that, or I got historical values of revenue for 2012, 13, and 14. And then I'm going to forecast 2015. I'm going to call this a very conservative DCF one-stage model. One stage meaning it's already in constant growth. And how I'm going to do that is I'm going to forecast the growth of sales next year. And what I'm going to do is either take the average of the last couple of years or last year, whatever is less. So that's a kind of a conservative way of thinking about it, that I'll take the last 2 years average unless last year is lower than that average, and then I'll use that. So I'm going to use 1.7%. Operating profit margin, Walmart has a pretty consistent operating profit margin, 5.9, 5.9, and 5.6. All right, I calculated that by actually inputting the operating profits for the last 3 years. If I take the ratio of operating profits divided by sales, these are the historical operating profit margins. Again, I'm going to be conservative. I want to take the average of the last 3 years or last year, whatever is less. That way, if it's trending down, I'll capture that. I then calculated historic last 3 years tax rates by going to their income statement and dividing tax over pre-tax income. So their tax rates has been 32, 31, 33. Again, to be conservative, I'm going to take the average of these or last year, whatever's higher. So I'll use last year's. So if I take my estimated revenue, 2015, multiply times my operating profit rate, I get my operating profit. Take 1 minus the tax rate, that's going to give me my net operating profit after tax. Now the last 2 years, their net reinvestment is about 20 and 21% of NOPAT. To be conservative, I'm going to take the average of those two, or last year, whatever's higher. So I'm going to assume they're going to reinvest 21% of this $18 billion to, say, upgrade stores, build other stores, and other projects they have. So that gives them a free cash flow to equity of $14 billion. Now, how I got these 20 and 21% is I went to the statement of cash flow and balance sheet, and I got the historic CapEx from the statement of cash flow. I got the historical depreciation from the statement of cash flow, and I got the historical working capital from the balance sheet. And what I did for the working capital is I took current assets minus cash minus current liabilities plus current long-term debt to get the net working capital. Now the change in the net working capital is what I need to capture for net reinvestment. So in 2014, they spent $13 billion on CapEx, but if I add back $9 billion, their net CapEx was about $4 billion, and the change in working capital is about $500 million. So last year, their net working capital is about $4 billion, which is 21% of NOPAT, and that's effectively what I'm going to use in the future. So going back to my model, I've now forecasted this top line here. $14 billion is my estimate for Walmart of next year's free cash flows to the firm. Now I need to calculate the WACC and an infinite growth rate, subtract out the debt, add back to cash, and divide by number of shares. So I collect some data from Yahoo Finance. I get the shares outstanding, total debt, cash, and market cap from key statistics. Tax rate, I've already estimated that over here. I go to Morningstar and look up Walmart and get the yield on, say, their 10-year bonds. So I took an average of non-callable bonds with a 10-year maturity. So I got about 360. I went to this DeModern webpage, clicked on data, current data, and I looked up the average unlevered beta adjusted for cash for an industry, and I believe I used general retail. So from DeModern data, the average beta for a firm for that industry, if they had no debt, was 0.85. Now for CAPM, I also need a market risk premium. I went back to the DeModern website, went to his current data, and found the implied risk premium. Now how DeModern gets this implied risk premium is by looking at every year at the current value of the S&P 500. He gets earnings estimates for cash flows, and then he backs into what discount rate could he apply to the estimated cash flows such that the present value of those cash flows is equal to the current market price of the index. If he were to get, say, 7% is the discount rate that equates the present value cash flows to the current price, he can then subtract off the current 10-year treasury rate, and that is the implied risk premium. So when I looked up on this date, it was 578. Now I'm ready to calculate WACC. I know my equity percent would be my market cap of equity divided by debt plus equity. My value of debt from the balance sheet over debt plus equity. I calculate beta, Walmart's beta, assuming it has the same business risk as the general industry. However, I multiply that times 1 plus the after-tax debt-to-equity ratio. So Walmart's equity or beta, I'm going to assume, is going to be 0.96. And the reason I like to use industry betas is they're much more stable. I don't really care about what the beta was last year. I'm looking for the beta for the next 100 years. So I'm going to assume that the firm's going to look more like the industry over time, and therefore I'm just going to adjust it for the firm's debt-to-equity ratio. My risk-free rate, I'll use the current 10-year treasury. So I'll use my CAPM formula, risk-free rate plus beta times market risk premium. So Walmart's cost of equity is $749. We know their cost of debt was $360, and with the tax rate, I can then calculate the weighted average cost of capital, $665. This gives me my total weighted average cost of capital. So now I know this is going to be about $14 billion. My WACC, $665. So if I assume that grows at some constant rate, I'll just it has to be less than the overall growth rate of the economy. I can then do a growth perpetuity formula. I'm going to assume that a 10-year Treasury is a proxy for the long-term nominal growth of the economy. So I'm going to assume that Walmart just grows with the economy. I would never use more than the 10-year Treasury rate when talking about perpetual growth, because you couldn't have a firm grow perpetually faster than the economy. So if I take their $14 billion over K my WACC minus G, Walmart should be worth $306 billion. Total value of the firm, debt and equity, or the total value of assets. If I take my net debt, debt minus cash, $49 billion, and subtract that from the total value of the firm, the equity of the firm should be worth $257 billion. If I then divide that by the total number of shares, 3.2 million, the value of Walmart should be about $80. And actually, I just looked up Walmart today, and Walmart was selling for about $79.30. So the model is giving me a pretty accurate value, even though 2 months ago it wasn't. The value of Walmart was more like 88. So this is a way of doing a DCF on Walmart. And I also just calculated a price to free cash flow. So my $79.91 is my intrinsic, or my fundamental valuation of Walmart's free cash flows to the firm, discounted at WACC, and then subtracting out debt. Now one other thing you could do is over here, notice this $79.91 shows up down to here. So the $79.91 assumes that $14 billion grows at 1.93% forever. Now I could calculate that another way. I can say, well, it grows at 193 for 1, 2, 3 down to 10 years. And then I can do the growth perpetuity formula again. It takes this cash flow over WACC minus constant growth rate 1.93, get a total firm value, subtract debt divided by number of shares, and I get back to the same value. So it doesn't matter whether I start the constant growth perpetuity next year or then have that constant growth for 10 years, then do the growth perpetuity formula again, because I'm going to take the present value back to today. But what this section allows me to do is, if you have some information you think they're going to grow above the constant or the growth of the economy for the next few years, say, maybe their new expansion strategy in Asia, they might grow at 5% for the next 5 years, then 4, then 3, then 2, then say their constant growth rate of 1.93. That would tell you that you think Walmart might be worth $95. So here again is assuming it grows at the constant growth rate starting next year. This is something called a growth ramp, which DeModern uses in his textbook, and says, well, you start at that base, you have some periods of abnormal growth, in other words, growth above the growth of the economy, and then by the end here, I'm going to then assume that it grows at the growth of the economy. So this would be the valuation if you assume above normal growth or above economic growth. So that's my DCF model. So in this topic, we looked at forecasting free cash flows for a firm, in that case a gold mine, and calculating free cash flows for Walmart in order to value their equity. We also used simulations to simulate stochastic variables and get probabilities at some cash flow estimates.